Welcome to our weekly earnings roundup for the fourth week of October 2024. I'm Roy from Financial Intake. In this video, we'll break down the key takeaways, major stock movements, and the trends driving these results. Among this week's summary highlights, you'll find reports from industry leaders like Google, Uber, Meta, Microsoft, and more. Stay with us until the end, and don't forget to like, subscribe, and hit that notification bell so you never miss our updates. Let's dive in and see what made headlines in the fourth week of October 2024. Today, we're diving into Ford's third quarter earnings report for 2024. In the next few minutes, I'll highlight key financial figures, significant trends, and future forecasts for Ford. If you find this analysis valuable, please hit that like button and subscribe for more quick financial insights. Ford reported a revenue of approximately $46 billion for Q3 2024, reflecting a 5% increase compared to the same quarter last year. This growth showcases the company's ability to expand its market presence, which is mainly driven by robust demand for traditional and electric vehicles. However, the net income decreased to $0.9 billion, a drop from $1.2 billion last year. This decline was mainly attributed to a $1 billion charge related to the company's ongoing investments in electric vehicle development. Despite this, Ford's adjusted EBIT for the quarter stood at $2.6 billion, indicating operational solid performance driven by improved vehicle sales and a favorable product mix. Let's break down some more key metrics. Ford Pro performance. The Ford Pro segment, which focuses on commercial vehicles, generated $1.8 billion in EBIT, demonstrating a robust margin of 11.6% on revenues of $15.7 billion. This highlights the strong demand for their Super Duty trucks and transit vans. Electric vehicle segment. The Model E segment, focused on EVs, reported an EBIT loss of $1.2 billion. Despite this, Ford is optimistic about improving its profitability in this area through strategic cost reductions and efficiency improvements. Now let's take a closer look at Ford's cash flow. Ford reported a solid cash flow from operations of $5.5 billion this quarter. This strong position enhances Ford's capacity for future investments and operational flexibility. In addition, Ford achieved an adjusted free cash flow of $3.2 billion, providing the company with the flexibility needed for future investments and operational adjustments. At the end of the quarter, Ford had nearly $28 billion in cash reserves, which is a critical buffer as it navigates ongoing challenges and invests in new technologies. As we look at the road ahead for Ford, there are several challenges that the company must navigate. One significant hurdle is the ongoing supply chain disruptions affecting the automotive industry. These issues have led to delays in production and difficulties in sourcing critical components, particularly semiconductor chips. Such constraints can impact Ford's ability to meet rising consumer demand, especially as the market shifts towards electric vehicles. Additionally, the competitive landscape is becoming increasingly fierce. Companies like Tesla and other emerging electric vehicle manufacturers aggressively pursue market share. Ford must enhance its electric vehicle offerings and develop innovative technologies to keep pace with this competition. Another challenge is the potential economic slowdown, particularly in key markets like China. Concerns about a recession or economic instability could lead to decreased consumers receive real-time updates and access features that enhance the overall ownership experience. Additionally, Ford is focusing on customer feedback to continuously refine its products and services. By leveraging data analytics, the company aims to understand customer preferences better and tailor its offerings to meet those needs. Looking ahead, Ford remains optimistic about its future prospects despite these challenges. The company has set ambitious goals for its electric vehicle segment, aiming for over 40% of its sales to come from electric vehicles by 2030. This ambitious target aligns with the growing consumer demand for sustainable transportation options and positions Ford as a serious contender in the EV market. Analysts project that Ford's earnings per share could reach approximately $2.50 next year, supported by new product launches and improved operational efficiencies. The rollout of new electric models and hybrids is expected to drive significant growth and bolster the company's market position. Ford's investment in battery technology is also crucial. By advancing its battery production capabilities, Ford aims to enhance the performance and affordability of its electric vehicles, making them more accessible to a broader audience. Ford is showing strong performance in its core business, with promising growth in electric vehicles. As we anticipate the impact of these strategies, stay tuned for their upcoming fourth quarter earnings report scheduled for February 5th, 2025. And don't forget to check out our videos for Apple's earnings report prep coming this Thursday. If you found this overview helpful, Please like this video and subscribe for more insights from Financial Intake. Thanks
Hello,
for
everyone,
watching,
and welcome back
see
to
you next
Financial
time.
Intake. Today, we'll dive into TransMedics' third quarter earnings report. In the next few minutes, you'll gain valuable insights into the company's performance, revenue growth, and what lies ahead. If you find this video helpful, please give us a thumbs up and subscribe for more quick financial analyses. Let's start. TransMedics reported a solid third quarter for 2024, with total revenue reaching $108.8 million, marking an impressive 64% increase compared to the same quarter last year, with $66.4 million. This growth is primarily driven by the increased utilization of their organ care system, OCS, across all organ types through their national OCS program. The company also generated a net income of $4.2 million, which translates to $0.12 per diluted share. This is a significant turnaround from the net loss of $25.4 million in Q3 2023, showcasing TransMedics' ability to scale its operations effectively. Let's take a closer look at the numbers. The gross margin for this quarter was 56%, down from 61% last year, primarily due to a higher proportion of service revenue, which typically carries lower margins than product sales. When it comes to operating expenses, TransMedics reported $56.9 million this quarter, a decrease from $69 million in Q3 2023. The previous year's expenses included a significant $27.2 million for non-recurring in-process research and development. It's worth noting that their investment in research and development has increased, reflecting their commitment to innovation. As of September 30th, 2024, TransMedics held $330.1 million in cash, compared to $362.8 million at the end of the previous quarter. This liquidity gives them room to continue investing in growth. Why did TransMedics stock drop 25% after the Q3 report? TransMedics stock experienced a significant drop of 25% after the release of its Q3 earnings report, and several factors contributed to this decline. Lowered guidance. TransMedics lowered its full-year guidance despite a substantial revenue increase. Analysts had anticipated more aggressive growth, but the updated outlook raised concerns about the company's ability to sustain momentum in the coming quarters. Margin pressure. The gross margin for the quarter decreased to 56% from 61% in the same period last year. This decline was attributed to a higher proportion of lower margin service revenue compared to product sales. Investors may have viewed this shift negatively, indicating potential challenges in profitability. Market reaction to expenses. While operating expenses decreased, the company's ongoing investments in research and development raised questions about future profitability. The market tends to react cautiously to increased spending in R&D, especially if it doesn't translate into immediate financial returns. Competitive landscape. TransMedics faces growing competition in the organ transplant sector, particularly from companies enhancing their technologies. The market may have been concerned about how well TransMedics can compete and capture market share in a rapidly evolving industry. Investor sentiment. Overall market sentiment can impact stock performance, and in this case, the combination of lowered expectations and concerns over margins may have fueled negative investor sentiment, leading to a significant stock drop. In summary, lowered guidance, margin pressures, competitive challenges, and overall investor sentiment contributed to TransMedics' stock decline following its Q3 earnings report. The company is also focusing on enhancing the customer experience. By improving their logistics and service offerings, they aim to ensure a seamless process for hospitals and transplant centers utilizing the OCS technology. This focus on customer satisfaction is vital for building long-term relationships in the healthcare industry. While the growth prospects are promising, TransMedics will need to navigate several challenges. They must continue expanding their market share and addressing competition in the organ transplant sector. Additionally, regulatory hurdles and maintaining high-quality service will be crucial for their ongoing success. Looking ahead, TransMedics maintains a positive outlook for the remainder of 2024, expecting revenue to be in the range of $425 million to $445 million, which represents a growth of 76% to 84% compared to last year. The company is on track to meet its ambitious goal of reaching 10,000 OCS transplant cases per year in the U.S. by 2028. Thank you for tuning in to this overview of TransMedics' Q3 earnings report. As we see, the company is making significant strides in the organ transplant market, but challenges remain. If you're interested in more financial insights, don't forget to check out our upcoming video analyzing Apple's earnings report this Thursday. Make sure to like, subscribe, and stay Hello,
updated
everyone.
on all the
I'm
latest
Roy from
financial
Financial
news.
Intake.
Today, we're diving into Sofi Technologies' third quarter earnings report for 2024.
In the next few minutes, I'll break down the company's key highlights, challenges, and outlook. By the end of this video, you'll have a comprehensive understanding of what's happening with SoFi and what to expect moving forward. If you find value in this content, please hit the like button and subscribe for more quick and insightful analyses. SoFi reported impressive net revenue of $697 million for Q3 2024, which marks a remarkable 30% growth compared to last year. This growth was driven by a 64% increase in the combined revenue from its financial services and tech platform segments, which now contribute 49% of total adjusted net revenue. The company also recorded a net income of $61 million, a significant turnaround from a loss of $266 million in Q3 2023. This shift highlights the effectiveness of SoFi's strategies and innovations. Notably, the company achieved a record-adjusted EBITDA of $186 million, reflecting a robust 90% increase year over year. Member and product growth. SoFi experienced a 35% growth in members, now reaching nearly 9.4 million, up from 7 million last year. In addition, the total number of products offered grew to 13.7 million, an increase of 31% year over year. Strong revenue streams. The financial services segment saw net revenue soar by 102% to $238 million, while the lending segment reported net revenue of $396 million, a 14% increase from last year. Innovative products. The launch of new products, including the SoFi credit card, contributed to increased member engagement and revenue. The company has also focused on enhancing its technology platform, which has shown promising growth in client accounts. Credit performance. SoFi's credit performance continues to improve, with a decrease in personal loan delinquencies and charge-off rates, indicating better risk management and underwriting practices. SoFi's cash flow dynamics are a significant highlight of their financial health. The company recorded a net interest income of $431 million for Q3 2024, reflecting a year-over-year increase of 25%. This growth was driven by a 35% increase in average interest earning assets, albeit slightly offset by a decrease in average yields. Moreover, net interest margin stood at 5.57%, which is slightly down from 5.99% in the previous year, primarily due to a mix shift towards lower-yielding secured loans. The company has also effectively managed its cash flow through a diverse product offering, with solid revenue generation from various channels. Overall, SoFi's robust cash flow reflects its strong market positioning and ability to adapt to changing economic conditions, providing a solid foundation for future growth. SoFi has placed a strong emphasis on improving the customer experience through innovative solutions and enhanced service offerings. Their recent initiatives aim to increase user engagement and satisfaction and ensure that members can efficiently manage their financial needs. While SoFi is on a growth trajectory, it faces several challenges, including increasing competition in the fintech space and potential regulatory pressures. Additionally, the ongoing economic conditions, including interest rate fluctuations, could impact the company's lending and borrowing operations. Looking ahead, SoFi Technologies is optimistic about maintaining its growth trajectory. The management team has raised its full-year guidance, now projecting adjusted net revenue between $2.535 billion and $2.550 billion. This forecast suggests a growth rate of approximately 22% to 23% year over year, driven by the continued expansion of their product offerings and increased member engagement. The company expects to add at least 2.3 million new members in 2024, leveraging innovative marketing strategies and improved customer experiences to attract more users. SoFi aims to further enhance its technology platform, which is crucial for maintaining a competitive edge in the fintech space. They are focusing on developing new financial products that cater to the evolving needs of their customers, particularly in the areas of personal loans, investment services, and insurance offerings. Moreover, as SoFi continues to expand its services and diversify its revenue streams, the integration of artificial intelligence and machine learning into their operations will be key to optimizing customer service and operational efficiency. The management is confident that these advancements will help sustain the momentum and drive profitability in the coming quarters. In summary, SoFi Technologies has shown remarkable growth in Q3 2024, demonstrating durable performance and strong financial health. As they navigate future challenges, their innovative approaches and customer-centric focus will be crucial. If you enjoyed this overview, don't forget to like and subscribe for more insights. And be sure to check out our upcoming video preparing for Apple's earnings report this Thursday. Thank you for watching, and I'll see you in the next video. Hello everyone, I'm Roy from Financial Intake. In this video, we're diving into PayPal's Q3 2024 earnings report. Over the next 5 minutes, you'll get valuable insights into PayPal's financial performance, key metrics, and what to expect moving forward. If you find this helpful information, please give us a thumbs up and subscribe for more quick analyses. PayPal reported impressive Q3 results, with net revenues reaching $7.8 billion, reflecting a 6% increase year over year. This growth was driven by increased consumer engagement and transaction volume. Operating income also grew, rising 19% to $1.4 billion, highlighting the company's effective cost management strategies. A noteworthy point is the non-GAAP EPS, which increased significantly by 22% to $1.20, compared to $0.99 in the previous year. This demonstrates PayPal's commitment to enhancing shareholder value while maintaining profitability. Delving deeper into the revenue streams, PayPal's total payment volume surged to $422.6 billion, a 9% year-over-year increase. The rise in transaction margin dollars, which grew by 8%, underscores PayPal's ability to scale operations effectively. Notably, PayPal has expanded its reach, now serving 432 million active accounts, reflecting increased user engagement and customer acquisition. Moreover, revenue from payment processing and fees and income generated from subscription services contributed significantly to the overall revenue growth, showcasing PayPal's diverse business model and adaptability to market trends. When we analyze key financial metrics, PayPal's GAAP EPS rose to $0.99, demonstrating strong performance relative to market expectations. The operating margin improved to 17.7%, indicating the company's efficiency in managing costs while increasing revenue. The company's balance sheet remains robust, with cash and cash equivalents totaling approximately $8 billion. This liquidity provides a cushion for future investments and potential acquisitions, ensuring that PayPal can continue to innovate and grow in a competitive landscape. PayPal generated $1.6 billion in cash flow from operations during Q3, a strong indication of its operational efficiency. The free cash flow was reported at $1.4 billion, enabling the company to invest in strategic initiatives while returning capital to shareholders through share buybacks and dividends. This positive cash flow highlights PayPal's ability to sustain its business operations and invest in growth opportunities, making it well-positioned for future success. Despite the positive results, PayPal faces challenges in the ever-evolving fintech landscape. The competition is intensifying, particularly from new entrants that target younger demographics with innovative solutions. Additionally, regulatory scrutiny across various markets could threaten PayPal's operational flexibility and market expansion strategies. Management acknowledges these challenges and is focused on improving customer experience and enhancing service offerings to maintain a competitive edge. Looking ahead, PayPal's management has raised its full-year guidance, projecting adjusted net revenues between $31.6 billion and $31.8 billion for the fiscal year. This optimistic outlook reflects confidence in PayPal's ability to grow user engagement and increase transaction volume. The company is particularly focused on expanding its product offerings in areas like buy now, pay later, BNPL, services, and cryptocurrency, aiming to capture new market segments and drive future growth. To recap, PayPal's Q3 results demonstrate solid growth across key metrics, bolstered by a robust cash flow position. However, the company must navigate upcoming challenges to maintain its market leadership. If you're interested in more insights, check out our upcoming analysis of Apple's earnings report this Thursday. Thank you for watching. If you enjoyed this overview, please like it and subscribe for more financial updates. Hey everyone, it's Roy from Financial Intake. Today, we're diving into Alphabet's latest Q3 earnings report. In this video, we'll break down Alphabet's business model and market position and highlight why they're staying ahead in an ultra-competitive space. We'll explore key revenue streams, profitability metrics, and management insights that tell us where this company is heading. You'll get a clear, concise overview of everything Alphabet achieved this quarter and what that means for the future. If you want a quick and accurate analysis of Alphabet and other prominent players in the market, hit that like button, subscribe, and stick around till the end for my take on what these numbers mean for investors. Let's get started. In Q3 2024, Alphabet achieved a robust financial performance, with consolidated revenues reaching $88.3 billion, a 15% increase year over year, or 16% in constant currency. This growth was driven by solid results across Google Services and Google Cloud, leading to an impressive operating income of $28.5 billion, up 34% from last year. With an expanded operating margin of 32% and a significant jump in EPS to $2.12, Alphabet shows strong profitability bolstered by its efficient cost management and revenue diversification. Alphabet's revenue streams performed exceptionally well this quarter. Google Services revenues rose 13% to $76.5 billion, boosted by solid growth in Google Search and YouTube ads. YouTube alone contributed significantly, achieving a notable revenue increase of $8.9 billion. Additionally, Google's other revenue channels, like subscriptions and devices, have shown sustained demand. Google Cloud. Cloud services marked a 35% increase to $11.4 billion, with Alphabet's AI-driven solutions, including its generative AI offerings, driving deeper client engagement and more significant deals. This positive segmental growth showcases Alphabet's ability to capitalize on AI innovation and meet diverse customer demands across advertising, cloud, and subscriptions. Now let's go over some key financial metrics for this quarter one. Revenue growth and profitability. Alphabet reported total revenues of $88.3 billion for Q3 2024, marking a 15% year-over-year increase and reflecting broad-based growth across Google Services and cloud segments. The strong revenue performance translated into an increase in net income to $26.3 billion, up 34% from the prior year, showcasing Alphabet's ability to generate high returns from its core operations. 2. Operating margin and cost efficiency. Alphabet achieved an operating income of $28.5 billion this quarter, with an operating margin expansion to 32% compared to 28% in the same quarter last year. This 4.5 percentage point increase highlights Alphabet's focus on operational efficiency, with initiatives aimed at reducing costs while scaling revenue-generating products. 3. Earnings per share, EPS. Diluted EPS increased substantially to $2.12, up 37% year-over-year from $1.55. This strong EPS growth reflects Alphabet's profitability improvements and disciplined cost management, which enhance shareholder value. 4. Segment performance and margin contribution. Google Services continued to be a major revenue contributor with $76.5 billion in revenue, driven by demand across Google Search, YouTube, and Google Play. Google Cloud, meanwhile, grew 35% to $11.4 billion, significantly improving its operating income to $1.9 billion, compared to $266 million in the prior year's Q3. These figures illustrate the positive impact of Alphabet's diversified revenue streams and strategic focus on high-growth areas, particularly within the cloud sector, which contributed notably to the overall operating margin. 5. Effective capital allocation. Alphabet's free cash flow remained strong, reaching $17.6 billion after capital expenditures, providing ample liquidity to support strategic investments in AI, infrastructure, and cloud technologies, while maintaining a healthy return to shareholders through stock buybacks and dividends. Summary. Alphabet's Q3 financial metrics underscore its robust revenue growth, operational efficiency, and profitability, underpinned by strategic investments in high-potential areas like Google Cloud and AI. These metrics signal Alphabet's commitment to sustainable growth and enhanced value creation for its stakeholders. Alphabet continues to demonstrate effective cash management. Operating cash flow. At $30.7 billion, the cash flow from operating activities remains strong, highlighting Alphabet's cash-generating capabilities. Free cash flow. After capital expenditures, Alphabet reported $17.6 billion in free cash flow, signifying robust liquidity that supports its ongoing investments in growth and innovation. While Alphabet's Q3 performance was stellar, challenges persist. These include increasing competition in the digital advertising space and regulatory scrutiny in multiple jurisdictions. Additionally, the shift toward AI introduces both opportunities and risks as Alphabet navigates competitive pressures in cloud services. Let's take a closer look at what next. 1. Continued investment in artificial intelligence. Alphabet remains highly focused on artificial intelligence, with plans to expand AI capabilities across its various products. CEO Sundar Pichai highlighted improvements in Google Search, now enhanced with AI-driven tools, broadening search possibilities and enhancing user experience. 2. Expansion of Google Cloud solutions. The cloud division, which generated $11.4 billion in Q3, a 35% increase, will continue receiving substantial investments, focusing on AI infrastructure solutions and generative AI. The company anticipates significant growth in its cloud client base, with new companies on board and expanded deals with existing customers. 3. Strengthening YouTube and advertising services. According to the report, YouTube's ad and subscription revenues exceeded $50 billion for the first time over the past year. Alphabet plans to continue enhancing YouTube's content offerings while developing new monetization and personalized advertising models, which are expected to further boost revenue from this segment. 4. Improving operational efficiency. Alphabet is committed to continuous efficiency and cost management improvements, evidenced by the increase in operating margin to 32%, up from 28% last year. The company intends to maintain this trend while also pursuing strategic investments in areas like AI and automation. 5. Addressing regulatory risks and macro forecasts. The company faces increasing pressure from global regulators, particularly in the US and Europe. Its current strategy includes closely monitoring emerging regulations and adapting as needed. Management also acknowledges potential impacts from macroeconomic factors, such as economic uncertainty within the digital advertising market. Summary of the outlook. Alphabet anticipates that its investments and advancements in artificial intelligence, cloud, and YouTube, combined with measured expense management, will drive sustainable growth in earnings and value over the coming years. Alphabet's Q3 2024 earnings underscore its sustained growth across services and cloud segments, efficient cash management, and profitable financial metrics. The company's proactive approach to AI innovation positions it well for future growth. Viewers interested in upcoming tech earnings should check out additional videos on our channel where we'll dive into other major tech players' quarterly results. Thank you for tuning in to this Q3 overview. If you found this analysis helpful, please like and subscribe for more updates on tech and financial news. Don't miss our next video on the latest earnings report from AMD, where we'll explore their Q3 earnings report. Welcome everyone, this is Roy from Financial Intake, and today we're diving deep into Reddit's Q3 2024 earnings report. By the end of this video, you'll understand Reddit's financial performance, key growth drivers, and the exciting path forward. If this sounds interesting, please like, subscribe, and stay tuned for all the insights you need. Reddit reported a 68% increase in revenue year over year, reaching $348.4 million, with GAAP profitability for the first time. They achieved a net income of $29.9 million, with a net margin of 8.6%. Advertising revenue also grew 56% year over year to $315.1 million, reflecting Reddit's increasing value as an advertising platform. Reddit also saw a remarkable surge in daily active users this quarter, with DAUs reaching an all-time high of 97.2 million, up 47% from last year. Key financial metrics. Advertising revenue. Advertising continues to be the primary revenue driver, with strong growth across various channels and verticals, including a high double-digit increase in performance revenue. Reddit has diversified its advertising base, reaching over 80% year-over-year growth in its scaled channel, which includes mid-market and SMB customers. Other revenue. Reddit's other revenue, primarily from data licensing agreements, grew 547% to $33.2 million, a significant milestone that highlights their potential beyond ad revenue. Gross margin. Reddit achieved an impressive gross margin of 90.1%, up 280 basis points from the previous year, underscoring its efficiency in scaling operations. Adjusted EBITDA. Adjusted EBITDA reached $94.1 million, with a margin of 27%, showing strong operational efficiency and cost management. ARPU, average revenue per unique. RPU increased by 14% to $3.58, highlighting Reddit's growing monetization efforts per user. In Q3 2024, Reddit demonstrated strong cash flow performance, generating $71.6 million in operating cash flow, an increase of $79.3 million from the prior year. This robust cash generation underscores Reddit's ability to fund its operations and growth initiatives from within without needing external resources. Free cash flow for the quarter reached $70.3 million, supported by disciplined capital expenditures of only $1.4 million, under 1% of total revenue, providing flexibility for reinvestment in product development and strategic growth. Reddit closed the quarter with $1.74 billion in cash equivalents, and marketable securities, positioning the company well for ongoing expansion. This prudent approach to cash management, balancing low expenditures with targeted investments, allows Reddit to maintain financial stability while pursuing its long-term goals. Reddit faces several challenges and risks as it continues to grow. The platform is dealing with increasing regulatory scrutiny, especially around data privacy and content moderation, which could lead to higher operational costs and impact its business model. In the competitive digital advertising market, Reddit must compete with major players like Google, Meta, and TikTok, challenging sustained ad revenue growth if advertisers shift their budgets. The company's success relies heavily on user engagement and retention. Any decline in user activity could directly affect ad impressions and revenue. As Reddit expands internationally through initiatives like machine translation, it faces rising costs associated with localization and infrastructure, which might pressure profit margins if the expected engagement does not materialize. Additionally, macroeconomic uncertainty could reduce advertising budgets, potentially impacting Reddit's revenue growth. Balancing these factors will be key to Reddit's continued success and stability. What next? In Q4 2024, Reddit projects revenue between $385 million and $400 million, with adjusted EBITDA of $110 million to $125 million, emphasizing its commitment to growth and profitability. Expanding its global reach, Reddit plans to extend machine translation to over 30 countries by the end of 2025, following success in markets like France, Spain, Germany, Brazil, and Italy. This initiative is designed to attract new users and advertisers by making Reddit content accessible worldwide. To enhance advertising effectiveness, Reddit is advancing its ad capabilities with AI-driven placements and improved conversation ads that foster deeper connections between brands and users. On the user engagement front, Reddit is introducing new features, such as an upgraded Ask Me Anything (AMA) format, to drive interaction and offer more value to advertisers. With a high 90.1% gross margin and positive cash flow, Reddit ensures efficiency in operations, supporting long-term initiatives without added cost pressure. Additionally, Reddit's data licensing business, which grew by 547%, is establishing itself as a valuable revenue stream, with plans to develop new partnerships beyond traditional advertising. In summary, Reddit's Q3 report shows strong revenue growth, improved profitability, and effective user engagement strategies that are setting the company up for sustained success. Make sure to check out our other earnings breakdowns for insights on the tech sector, and if you're curious about Reddit's next steps, subscribe and stay tuned for more. Hey everyone, it's Roy from Financial Intake, and today we're diving into Microsoft's Q1 FY25 earnings report. With substantial growth across its core businesses and ongoing AI-driven advancements, Microsoft has again shown why it's a tech giant worth watching. From revenue in the cloud to gains in productivity and gaming, this report gives us a comprehensive look at the company's current performance and vision for the future. In today's video, we'll explore Microsoft's financial highlights, break down growth in key segments like intelligent cloud, and discuss the impact of the latest AI initiatives on their performance. Stick around if you're interested in understanding how Microsoft is transforming through innovation and why investors are excited. If you like this breakdown, be sure to like, subscribe, and let's jump into it. Starting with the financial overview, Microsoft reported revenue of $65.6 billion this quarter, marking a 16% increase year over year. The company's operating income rose to $30.6 billion, up 14%, while net income reached $24.7 billion, an increase of 11%. This translates into diluted earnings per share of $3.30, a 10% rise from last year. CEO Satya Nadella emphasized Microsoft's role in an era of AI-driven transformation, impacting nearly every role, function, and business. Nadella pointed to their success in helping clients leverage Microsoft's AI platforms and tools to drive growth. CFO Amy Hood credited the 22% year-over-year increase in Microsoft Cloud revenue as a key contributor, with the cloud reaching $38.9 billion, highlighting strong execution from sales teams and partners. These figures reflect Microsoft's balanced approach, with growth driven by cloud adoption, productivity tools, and consumer offerings supported by strategic cost management. Microsoft's Productivity and Business Processes segment, which includes offerings like Microsoft 365, LinkedIn, and Dynamics, recorded $28.3 billion in revenue, a 12% increase. This growth was bolstered by Microsoft 365's continued popularity among commercial and consumer customers. Specifically, Microsoft 365 Commercial saw a 13% revenue increase, driven by cloud services growth at 15%. On the consumer side, Microsoft 365 recorded a 5% revenue boost, pointing to strong demand across sectors. LinkedIn contributed with a 10% revenue increase as the platform continues expanding its advertising and learning solutions. Meanwhile, Dynamics products and cloud services grew by 14%, with Dynamics 365 seeing an impressive 18% growth, further evidence of Microsoft's strategic focus on business solutions. These numbers indicate how Microsoft has embedded itself deeply in workplace productivity, with organizations worldwide increasingly dependent on its tools for collaboration and efficiency. Next, we move to the intelligent cloud segment, where Microsoft saw exceptional performance. This segment, led by Azure and server products, reported $24.1 billion in revenue, a 20% increase year over year. Azure itself grew 33%, showing the impact of Microsoft's continuous advancements in AI and cloud-based technologies. With more businesses seeking scalable AI solutions, Microsoft's cloud offerings have become indispensable, particularly as organizations adapt to new digital workflows. With a robust product lineup, including databases, machine learning, and hybrid cloud infrastructure, Azure's growth highlights its competitive edge. In constant currency, Azure's growth was even higher at 34%. This segment positions Microsoft as a leader in the cloud industry, directly competing with giants like Amazon AWS and Google Cloud. As businesses shift toward digital-first models, Microsoft's intelligent cloud provides them with the tools for data analytics, storage, and AI-driven insights, making it one of the company's most resilient growth engines. The more personal computing segment recorded $13.2 billion in revenue, marking a 17% increase year over year. This growth was led by Xbox content and services, which surged 61%, primarily due to the Activision acquisition. Additionally, Windows OEM and devices revenue grew by 2%, indicating a modest recovery in PC demand. Search and news advertising, excluding traffic acquisition costs, rose by 18%, supported by advancements in Microsoft's AI-powered search capabilities. The Activision acquisition added substantial value to Microsoft's gaming portfolio, positioning Xbox to better compete in the gaming market. As a result, Xbox continues to benefit from Microsoft's cross-platform strategy, where content is integrated across devices, cloud, and streaming services. This segment shows Microsoft's success in diversifying revenue streams, with products ranging from consumer electronics to digital advertising, all while positioning Xbox as a top gaming service globally. Microsoft demonstrated strong cash flow management this quarter, returning $9 billion to shareholders through dividends and share repurchases. With significant cash reserves and a history of disciplined spending, Microsoft continues to invest in growth areas while also rewarding shareholders. This strategy of balancing internal investment with shareholder returns has positioned Microsoft as a financially stable company, able to pursue long-term growth while ensuring short-term returns. For investors, this means Microsoft's stock remains attractive, as the company leverages its cash flow for innovation and consistent returns. Microsoft is also pursuing significant business initiatives and product enhancements. This quarter, the company released numerous updates across Microsoft 365, Azure, and Dynamics 365, reflecting years of R&D aimed at improving productivity and security. Microsoft's AI-driven upgrades span various tools, from workplace productivity in Microsoft 365 to data management and analytics in Azure. This dedication to innovation has helped Microsoft strengthen its market position while expanding its customer base. By focusing on continuous product development, Microsoft ensures it remains at the forefront of technological advancements and user satisfaction. Looking ahead, Microsoft's focus remains on AI and cloud innovation. However, the company faces some challenges, including intense competition from other tech giants and regulatory scrutiny, especially around data privacy and AI ethics. These issues could influence Microsoft's operating model and affect its ability to launch new products freely. Despite these challenges, Microsoft is well positioned to continue its growth trajectory, especially as businesses globally seek scalable AI and cloud solutions. Microsoft's commitment to responsible AI usage and its investments in sustainability also underscore its readiness to adapt to a changing market landscape, ensuring the company remains resilient against potential headwinds. In summary, Microsoft's Q1 FY25 earnings highlight its strong position in the tech landscape, with impressive growth in cloud, productivity, and personal computing segments. The company's investment in AI-driven solutions, combined with its strategic approach to growth, positions Microsoft as a leader in innovation and value creation for investors. If you enjoyed this breakdown and want more insights like these, hit that like button, subscribe, and don't forget to share your thoughts in the comments. Thank you for watching, and stay tuned for more financial analysis on your favorite companies. Hey everyone, it's Roy from Financial Intake. Today we're breaking down Meta's Q3 2024 earnings report. With a strong quarter driven by AI and immersive tech innovations, Meta has made significant gains this year. From growth in ad impressions to progress in reality labs, Meta is paving the way for the next stage of digital interaction. This video will review Meta's revenue, segment performance, and key growth areas. By the end, you'll understand how Meta's strategies impact its financial health and future potential. If this sounds interesting, don't forget to like, subscribe, and stay tuned for all the insights. Starting with the financial highlights, Meta reported $40.59 billion in revenue, a 19% year-over-year increase. Operating income was $17.35 billion, up 26% from last year, and net income reached $15.69 billion, showing a substantial 35% growth. Diluted earnings per share also rose to $6.03, a 37% increase. CEO Mark Zuckerberg attributes this growth to Meta's advancements in AI, including Llama, their language model, and Meta AI-powered products like smart glasses. These innovations align with Meta's push towards creating interconnected and immersive experiences across its platforms. With these results, Meta demonstrates its resilience and adaptability, showcasing how AI and tech investments enhance operational efficiency and drive new revenue streams. CFO Susan Lee notes that this strong quarter is supported by effective cost management and increased ad revenue, indicating a positive trend as we approach the year's end. The family of apps segment remains Meta's core revenue driver, pulling in $40.32 billion, a 19% increase year over year. This growth is primarily from advertising revenue, which rose to $39.89 billion. Here's a closer look at some key points. Ad impressions. Delivered across the family of apps, impressions grew 7% year over year. This reflects Meta's continued ability to attract high engagement on platforms like Facebook, Instagram, and WhatsApp. Average price per ad. This metric increased by 11%, highlighting Meta's success in maximizing revenue from each ad displayed. This improvement is partially due to the adoption of more AI-enhanced targeting, making ads more relevant to users. With a massive 3.29 billion daily active people across its apps, Meta's family of apps provides a vast user base for advertisers and leverages advanced algorithms to increase ad effectiveness. This segment shows how Meta remains an essential tool for advertisers, further bolstered by AI-driven insights and engagement. The Reality Labs segment, Meta's division focused on AR, VR, and immersive technologies, recorded $270 million in revenue. While still a small portion of overall revenue, Reality Labs represents Meta's long-term vision of creating the metaverse. However, the segment reported a loss of $4.43 billion this quarter, reflecting the high cost of pioneering new technology. Zuckerberg mentioned that the adoption of AR and VR devices is growing steadily, with recent launches of Meta AI-powered smart glasses and updates to the Oculus platform. Despite the current financial losses, Meta invests heavily in Reality Labs, confident that these immersive technologies will eventually reshape how people interact and work. The goal for Reality Labs remains clear: to develop innovative experiences and devices that bring digital and physical worlds closer together. While these investments are costly now, they align with Meta's strategic pivot toward future growth areas beyond traditional social media. Meta's cash flow this quarter reflects a solid financial position. Free cash flow reached $15.52 billion, supported by disciplined spending and efficient operations. Meta continues its shareholder return program, repurchasing $8.86 billion of Class A common stock this quarter and maintaining cash reserves of $70.9 billion. This approach highlights Meta's commitment to balancing internal reinvestment with rewarding shareholders. By maintaining a solid cash position, Meta can comfortably fund its innovative projects while securing returns for investors. For those looking at Meta as a long-term investment, this combination of strategic spending and shareholder returns is a reassuring sign. Meta has made notable progress in its AI initiatives, transforming how the company interacts with users and advertisers. Key advancements this quarter include Meta AI and Llama. Meta's in-house AI language model, Llama, has seen significant adoption. This model is now integrated across apps, providing personalized recommendations and enhancing user engagement. AI-powered glasses. Meta also introduced smart glasses with built-in AI capabilities. These glasses are designed to enhance real-world interaction with digital information, representing a key step in Meta's ambition to create a more immersive user experience. These initiatives reflect Meta's commitment to integrating advanced technology into its ecosystem, positioning it as a leader in AI innovation. The company's emphasis on AI improves ad targeting and platform functionality and lays the groundwork for more meaningful interactions in the future. Meta has forecasted Q4 revenue between $45 billion and $48 billion, highlighting continued momentum as the year closes. However, challenges remain. Regulatory scrutiny is intensifying in the US and EU, particularly concerning data privacy and content moderation, which could impact Meta's operations and revenue. In addition, Reality Labs' costs are expected to increase as Meta continues developing AR/VR devices and metaverse projects. While these investments are crucial for Meta's long-term strategy, they place immediate pressure on profitability. The company's focus on balancing growth with compliance will be essential to navigate these external risks while expanding its tech offerings. In conclusion, Meta's Q3 2024 results reveal a company deeply committed to innovation and transformation. From significant revenue growth in the family of apps to pioneering efforts in Reality Labs, Meta is shaping the future of digital interaction. Their strong cash flow and shareholder return strategy further underline a stable financial base, providing confidence to investors. If you enjoyed this breakdown and want to keep up with Meta's journey into the future, don't forget to like, subscribe, and leave your thoughts below. Thanks for watching, and stay tuned for more financial insights on your favorite companies. Hey everyone, it's Roy from Financial Intake. Today, we're diving into Uber's Q3 2024 earnings. Uber has had an impressive quarter with growth across its core services and new initiatives in autonomous tech, airport shuttles, and more. Whether you're curious about Uber's financial performance or the company's direction, this video covers it all. We'll break down Uber's revenue highlights, key metrics, and outlook. So, if you're interested in understanding how Uber is scaling up while improving profitability, stick around. Don't forget to like and subscribe, and let's jump into it. Let's start with Uber's overall financial performance. Uber reported $41.0 billion in gross bookings, a 16% year-over-year increase, 20% in constant currency. Revenue reached $11.2 billion, up 20% from last year, while income from operations hit $1.1 billion, marking a new milestone with a 169% increase. Net income came in at $2.6 billion, boosted by a $1.7 billion gain from equity investments. Adjusted EBITDA was $1.7 billion, up 55%, showing efficient cost management alongside revenue growth. CEO Dara Khosrowshahi highlighted Uber's profitable growth, crediting the success to its versatile platform. He noted Uber's progress in rider verification and autonomous vehicle partnerships, underscoring the company's vision of a safer, more innovative future in mobility. CFO Prashanth Mahendra-Rajah added that Uber is well-positioned for growth, maintaining a strong outlook with strategic investments and share repurchases. Moving on to the mobility segment, Uber's primary revenue driver, which brought in $21.0 billion in gross bookings. This represents a 17% year-over-year increase or 24% in constant currency. Revenue for mobility grew to $6.4 billion, marking a 26% increase as Uber continues to expand rideshare options and improve user safety. A significant highlight is the increase in Uber's mobility-adjusted EBITDA, which rose 31% year-over-year to $1.7 billion. This growth was largely due to increased trip volumes and improved cost efficiency. In Q3, Uber also launched several new features, including airport shuttles, enhanced rider verification, and expanded partnerships for autonomous rides in cities like Austin and Atlanta. This segment highlights Uber's focus on innovation, catering to more customer needs, and enhancing driver and rider experiences. In the delivery segment, gross bookings rose 16% year-over-year to $18.7 billion, driven by strong demand across Uber Eats and growing ad revenue. Revenue from delivery reached $3.5 billion, an 18% increase. The segment's adjusted EBITDA was $628 million, up 52% from last year, with a margin improvement to 3.4% of gross bookings. Uber continues to enhance its delivery ecosystem, introducing features like Uber Eats Lists and Bites, a short-form video feed for discovering popular dishes. Additionally, Uber expanded its merchant partnerships, adding well-known brands and local options, and introduced sustainable packaging options, showcasing Uber's commitment to diverse offerings and environmental responsibility. The growth in this segment indicates that Uber's investment in expanding and refining its delivery services is paying off. The freight segment, while smaller, also showed resilience, with $1.3 billion in revenue and 2% year-over-year growth. This segment saw advancements in AI-based solutions for freight management, such as Insights AI for real-time data analytics, helping shippers optimize logistics. Although freight reported an adjusted EBITDA loss of $19 million, Uber continues to expand its freight capabilities by launching new partnerships and refining logistics solutions. As Uber builds out freight's infrastructure, the focus remains on leveraging AI and automation to capture a larger share of the logistics market. Uber's cash flow this quarter was robust. Operating cash flow totaled $2.2 billion, while free cash flow reached $2.1 billion, a 133% year-over-year increase. Uber also returned value to shareholders by repurchasing $375 million of its stock and ended the quarter with a solid cash reserve of $9.1 billion. This cash flow strength gives Uber a strong foundation for future investments in technology and market expansion. For investors, Uber's balance between growth spending and shareholder returns underscores its commitment to sustainable growth. Uber has taken significant steps toward innovation this quarter, particularly in autonomous technology and new consumer offerings. Key initiatives include expanded autonomous partnerships. Uber announced partnerships with companies like Waymo and Cruise to provide autonomous ride-hailing in select cities. Uber One and membership growth. Uber's loyalty program reached over 25 million members, and it expanded its base with offerings like Uber One for students. Sustainable and convenient offerings. Uber launched eco-friendly options in Uber Green, allowing riders to choose electric vehicles in 40-plus cities, as well as features like Turo integration for renting cars within the Uber app. These initiatives reflect Uber's commitment to delivering cutting-edge solutions for both drivers and riders, setting a foundation for long-term growth. Looking ahead, Uber's Q4 2024 forecast indicates a steady trajectory, with projected gross bookings between $42.75 billion and $44.25 billion. Adjusted EBITDA is expected to reach $1.78 billion to $1.88 billion, a year-over-year growth of up to 47%. However, challenges persist, such as navigating global regulations, ensuring competitive pricing, and expanding in a cost-effective way. Uber's focus on autonomous technology and international growth shows its forward-thinking approach, but managing costs and addressing regulatory challenges will be essential. With strategic investments and partnerships, Uber is positioning itself to tackle these challenges head-on. In conclusion, Uber's Q3 2024 results show strong growth across segments, robust cash flow, and a strategic focus on future innovations. With investments in autonomous technology, expanding services, and a strong cash position, Uber is building a diversified platform for long-term success. If you found this breakdown useful, don't forget to like, subscribe, and let me know your thoughts on Uber's journey. Hey everyone, it's Roy from Financial Intake, and today we're diving into Robinhood's Q3 2024 earnings report. This quarter has been exceptional for Robinhood, with solid revenue growth and exciting new products launched to attract active traders. Whether you're invested in Robinhood or curious about the latest in the trading world, this video is for you. We'll cover Robinhood's revenue growth, key product milestones, and outlook for the future. If you're interested in learning how Robinhood is shaping the future of trading, don't forget to like and subscribe. Let's get started. Robinhood's revenue reached $637 million this quarter, a 36% increase year over year and its second highest revenue. Net income reached $150 million, with a GAAP EPS of $0.17, an improvement from last year's loss. The company's adjusted EBITDA surged 96% to $268 million, reflecting Robinhood's efficiency and growing profitability. CEO Vlad Tenev credited this growth to a smoothly running product engine with significant investments in new offerings. CFO Jason Warnick emphasized that Robinhood's goal for profitable growth is well on track, with these results breaking previous records for revenue and earnings per share. This financial strength sets Robinhood apart in the competitive fintech space, highlighting its potential for sustainable growth as a significant player in online trading. Transaction-based revenues, representing a large portion of Robinhood's income, grew by 72% year over year to $319 million, with each segment contributing significantly. Options trading revenue reached $202 million, marking a 63% increase driven by rising demand from active traders. Cryptocurrency trading saw impressive growth, with revenue increasing by 165% to $61 million, reflecting heightened interest in the digital asset market. Equities trading revenue rose by 37% to $37 million as trading volumes rebounded. These transaction-based revenues underscore Robinhood's adaptability to market trends and user preferences, positioning the platform to capitalize on the demand for diverse asset classes as more active traders engage. Robinhood's net interest revenue increased 9% year over year to $274 million, primarily due to growth in interest-earning assets and customer cash balances in the cash sweep program, which grew to $24.5 billion, up 80% year over year. The Gold subscription service also saw a 65% increase in subscribers, with 2.2 million users now signed up, contributing to $44 million in other revenue, a 42% increase. Robinhood's focus on subscription and interest revenue shows a strategic effort to diversify income sources beyond transaction fees, creating a steady revenue stream less reliant on trading volume fluctuations. This quarter, Robinhood introduced several products aimed at active traders, starting with Robinhood Legend, a new desktop trading platform designed with advanced tools for power users. They also launched the presidential election market, giving users a unique way to engage with market trends related to current events. Other upcoming features include futures and index options trading and a realized profit and loss tool aimed at solidifying Robinhood's presence in the active trading community. Robinhood also held its first ever Hood Summit, a conference bringing customers and industry leaders together, reinforcing its commitment to creating a trader-centered community. Robinhood generated a robust $2.1 billion free cash flow, a 133% year-over-year increase. The company also executed share repurchases worth $97 million, representing 5 million shares. Robinhood's cash reserves remain strong at $4.6 billion, providing flexibility for future investments and shareholder returns. This strong cash position enables Robinhood to continue its growth trajectory, funding product development and potential acquisitions. For investors, the cash flow strength and buyback program underscore Robinhood's dedication to delivering value both through internal investments and returns. Robinhood's user metrics this quarter indicate a steady growth in engagement. Funded customers increased by 1 million, reaching 24.3 million users. Assets under custody, AUC, surged 76% year over year to $152.2 billion due to higher equity and crypto valuations. Monthly active users, MAUs, rose by 7% to 11 million. With these metrics, Robinhood is showing its ability to retain and grow its user base, which is essential for long-term growth. The increase in AUC and active users reflects strong engagement, particularly with younger and newer investors, positioning Robinhood well in the competitive landscape. Looking ahead, Robinhood is maintaining its expense outlook, with GAAP operating expenses projected between $1.86 billion and $1.96 billion for the year. They plan to focus on product innovation and expanding internationally, including a UK rollout of options trading set for 2025. Robinhood's challenges include navigating regulatory scrutiny and managing market volatility's impact on transaction volumes. The company's strategy of expanding its product offerings and strengthening active trader engagement will be key in sustaining its growth and building resilience against external pressures. Robinhood's Q3 2024 results show strong growth in revenue, cash flow, and user engagement, driven by new product launches and a focus on active traders. With a promising outlook and ongoing innovations, Robinhood is positioning itself as a go-to platform for a new generation of investors. If you found this breakdown useful, be sure to like, subscribe, and share your thoughts in the comments. Thanks for watching, and stay tuned for more insights.
Hey everyone,
on
it's
leading
Roy
companies
from
in the
Financial
finance
Intake,
and
and
tech
today
sector.
we're diving into Eli Lilly's Q3 2024 earnings report. Eli Lilly reported significant growth this quarter, with key contributions from new product launches and groundbreaking advancements in its clinical pipeline. Whether you're an investor or just curious about the pharma industry, this video will cover it all. We'll explore Lilly's revenue growth, major product performances, and future outlook. If you're interested in understanding how Lilly is navigating its growth strategy, don't forget to like and subscribe, and let's get started. Starting with Lilly's overall financial performance, the company reported $11.44 billion in revenue, a 20% increase year over year. On a reported basis, earnings per share, EPS, reached $1.07, while non-GAAP EPS was $1.18, reflecting strong performance across its product portfolio. Excluding the previous year's sales from its olanzapine portfolio, total revenue surged 42%. CEO David Ricks attributed this growth to volume increases from key products like Mounjaro and Zepbound, along with their oncology, immunology, and neuroscience portfolios. CFO Susan Li also highlighted improvements in gross margin and strategic cost management as Lilly invests in future innovations. This quarter underscores Eli Lilly's strength
in bringing novel treatments to market and maintaining financial discipline, setting the company up for a promising year-end. Lilly's new products contributed significantly to this quarter's performance, reaching 4.51 billion in revenue. Leading products Mounjaro and Zepbound saw high demand, with Mounjaro's revenue alone reaching $3.11 billion, largely driven by demand in the US for diabetes management and obesity treatments. Revenue from Verzenio, an oncology treatment, increased by 32% year-over-year, showing strong demand growth both domestically and internationally. Additionally, Taltz saw an 18% increase, reflecting higher prices and increased patient demand in immunology. However, Trulicity experienced a 22% decline, attributed to competitive pressures in the diabetes market. These revenue drivers indicate Lilly's successful strategy of diversifying its portfolio with high-demand products that cater to some of the most pressing global health needs. This quarter was pivotal for Lilly's pipeline with major approvals and promising clinical data. In Q3 2024, the FDA approved Ebglyss, a first-line biologic for moderate to severe atopic dermatitis, broadening Lilly's reach in immunology. In Japan, Kisunla was approved for early symptomatic Alzheimer's, offering hope for patients in the neurodegenerative disease space. Lilly also shared positive phase 3 data from a 176-week tripeptide study showing a 94% reduction in type 2 diabetes risk in pre-diabetic adults with obesity. The Trailblazer AL6 trial demonstrated that modified dosing reduced adverse events in Alzheimer's patients while maintaining amyloid plaque reduction. These advancements not only showcase Lilly's commitment to addressing unmet needs in chronic conditions, but also strengthen its competitive edge with innovative treatments in its pipeline. This quarter was pivotal for Lilly's pipeline with major approvals and promising clinical data. In Q3 2024, the FDA approved Ebglyss, a first-line biologic for moderate to severe atopic dermatitis, broadening Lilly's reach in immunology. In Japan, Kisunla was approved for early symptomatic Alzheimer's, offering hope for patients in the neurodegenerative disease space. Lilly also shared positive phase 3 data from a 176-week tripeptide study showing a 94% reduction in type 2 diabetes risk in pre-diabetic adults with obesity. The Trailblazer AL6 trial demonstrated that modified dosing reduced adverse events in Alzheimer's patients while maintaining amyloid plaque reduction. These advancements not only showcase Lilly's commitment to addressing unmet needs in chronic conditions, but also strengthen its competitive edge with innovative treatments in its pipeline. Lilly's key initiatives this quarter focus on accessibility and expanding its product reach. They launched Zepbound in new dosage formats via Lilly Direct, increasing access to diabetes and obesity treatments. Lilly also completed the acquisition of Morphic Holding, expanding its immunology pipeline with new therapeutic options. Lilly continues to build upon these acquisitions and product extensions by investing in R&D and expanding global access to its treatments, particularly in underrepresented therapeutic areas. These initiatives reflect a balanced approach to growth, with a focus on improving patient access and driving product innovation. Looking ahead, Lilly has updated its full-year revenue guidance to $45.4 to $46.0 billion, with EPS expected in the range of $12.05 to $12.55 on a reported basis and $13.02 to $13.52 on a non-GAAP basis. Challenges include managing the scale of its production and addressing competitive pressures, especially in high-demand areas like diabetes and immunology. Despite these challenges, Lilly's focus on product innovation and global expansion provides a solid foundation. Their investments in both established and new markets, supported by groundbreaking clinical data, indicate that Lilly is well prepared for long-term growth and resilience. In conclusion, Eli Lilly's Q3 2024 earnings reflect a company on a strong growth trajectory driven by new product successes, significant clinical milestones, and strategic investments. Lilly's innovations in diabetes, Alzheimer's, and immunology continue to demonstrate its impact in the healthcare industry. If you found this breakdown helpful, please like, subscribe, and let me know your thoughts on Lilly's strategy and future. Thanks for watching, and stay tuned for more financial insights on top companies.